Hello, welcome to this session again. And in this session, we are again going to talk about candlestick intelligence. Now, the sessions we are going to cover are part of our premium course structure. And thanks for subscribing, because of which you have got these sessions. So, let's start. So, in this session, specifically, what you are going to cover? You are going to cover institutional candle traps and breakouts, and then the complete trading system. So, what you are going to get after this session? You are going to understand false breakout identification, and then the understanding of liquidity and stop hunts, then differentiation between real and fake breakouts, and then you will have high probability losing trades avoidance, how to avoid those losing trades, and you just have to get into the high probability winning trades, and you have to start thinking like a professional participant, not as a beginner. So now let's talk about breakouts. Now let's start with breakouts first. So most breakouts don't fail randomly, they fail because they were designed to trap participation before the real move actually arrives. So what happens, you would have seen that there was a perfect breakout kind of setup which is coming on the chart, but you enter into it, but the price immediately reverses. So once price has reversed, then you are wondering why it happened. And that's why we are saying that many breakouts are designed to trap participants in this breakout. So market makes lots of positioning. Big participants make lots of positioning so that they trap the retail investors or the new beginners, because the new investors or beginners won't have complete view of the market. They will think that the market is going through a breakout, but that breakout will fail, and that will help out the big participants, and we will show you how it happens. So once we show it, you will understand how markets actually work out inside out. So now what is a breakout? Breakout is once we have got one resistance level, which we have already explained you. Once we have got a resistance level, then if you can see on this screen, so what is a breakout? So breakout is once we have defined our resistance level, after that resistance level, if market goes up, that is the breakout. If it goes down after touching that resistance level, it's a failure. So now, how to identify a breakout? A genuine breakout, what will happen there? So there are three main conditions for that. So first characteristic of a true breakout is that it has got a strong close beyond that particular level. So when we say this, what does it mean? So this is our breakout level, and if market is showing a strong support above this line, then only it is considered as a breakout. So now if you look at this line, which we can extend here, till this point market is not staying, market is just reversing on the same day. Market has touched here, has gone a little bit up, and after that it has reversed. So first condition is not fulfilling, which we mentioned as strong close beyond the level. So this was the level, and we are not seeing any strong close here, here, and here beyond this level. So that's why the breakout is failing. But here you can see there is a strong close beyond this level. When we say strong close, that means price may go up and then it may reverse. So this is not a strong close, but price goes up and stay above this line, then it's a strong close. And if it is a big green candle, like in this we have a big green candle, so all we have already discussed the importance of these big green candles and big red candles. So if it is a big green candle, then it provides you kind of confirmation that yes, there is a strong momentum on the upside, and now the breakout has happened. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buying, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Second characteristic of the good breakout, and that is that follow through in the next candle should happen. So this candle has seen the breakout, but what about the next candle? That is very important. So in the next candle also we can see continuation of breakout. So it's a strong candle. Now you can see here, as we defined previously, it is creating higher highs and higher lows. So two higher highs and higher lows that means a very strong candle, and that means the trend is up and we can safely enter in the market at this point of time. And third very important one is, so we have covered two situations. Now the third situation is that sustained price movement. After that, we can see we already got the confirmation. Now we can enter into it, but now we will see that it should be having a sustained price movement. So it's a sustained price momentum which is coming. If it started to go down, suppose here we have got a red candle, then we will wait and look for the confirmation. Next day again it's a green candle. But suppose this red candle would have made lower highs and lower lows, then we would have been little bit cautious. Till what point? We will cover all of that and you will get from the experience, and that's where we are going to have our classes as well, where you can ask these particular questions, because everything cannot be covered in these recorded sessions, and that's where we have provided the facility of live classes as well. So we have covered three main conditions and you have to see all of them. You can just rewind and see those conditions, what those conditions are. Now let's talk about a false breakout. So false breakout, we also call it a trap. Trap means it is designed by the big participants to trap you. So what happens? A trap occurs when a price breaks a level, but quickly it moves inside that. Now for this chart, we had defined our resistance level at this point of time, and at this place you can see breakout could not happen and we could judge it because there is no candle above this one, because there is no strong close here. Here also, as per the things identified in the previous few minutes, we have defined three conditions. So here is also there is no strong close, but if you look at this one, this candle is a strong close because it is safely above our breakout candle. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Okay, because it is safely above our breakout level. Now what has happened? So our second condition was that follow through in the next candle. In the next candle, follow through was not there. So in the next two candles, price was not sustained and it fell again into the range. So that is a false breakout. But after some time, it went up. This was not a great breakout. So it was just touch and go. And so we should not be taking any positions here. But this was a strong breakout. So you can see we have defined here the trap here, and after that here we have defined a correct breakout also. So now just try to understand what has market tried to do here. They have tried to do a stop loss hunt. What do you mean by stop loss hunt? Now this is called stop loss hunt. What has happened here is called stop loss hunt. Let me explain what has happened exactly. So now what is that stop loss hunt? Let me explain you. So there are many people who would be considering this as a very important resistance zone. Now suppose you are a short seller. So what do you want to do? You will sell the stock here, right? And you want stock to go down, but you will need to have a stop loss. What you will do? You will keep your stop loss just at this line or about or just at this line. Or even if you are not a short seller, you are just a simple buyer, investor. You think that once market breaks out of this level, then I will buy. So in both the cases, whether you are a short seller or whether you are just a buyer, you want to buy the stock at this point of time and you have put your limit order here. So once limit order simply means that once price reaches this point, then your order will be triggered. Now there are many big investors who would be aware of this fact. Definitely they would be aware. Now what they want, they would have bought at this point. Now they want to maximize their gain. They will slowly take the markets to this level and they will put some sell orders here at this point of time. They will slowly take market to this level and they will keep some sell orders beyond this line. So what will happen then when the markets sell and buy orders are matching, when market making activity is happening, then system will consider there are certain sell orders at this point of time. They will be shown to the buyers, and once buyers see that there are many people who are willing to pay beyond this price, they will think that people are becoming bullish, market is becoming bullish. So the buy order which those people had put it here, that will be triggered. So once the buy order has been triggered, that means for this investor who had bought here and wanted to sell here, he got the liquidity. That means his sell order will go easily at this point of time. But this was a fake breakout design, and after that market falls below. So that's how it happens. These are called the stop loss hunt, and these are called the trap. So why it happened and why the less experienced traders got into this trap? Because they basically focus on breakouts, and more experienced participants focus on the reaction after the breakout. So generally what we should do, we should wait for a day at a point where the breakout is happening, and once we have got that confirmation, then only we should buy it. Or as explained in previous sessions, that you can try to take confirmation on the shorter version of the chart as well, maybe 1 hour chart, maybe 30-minute chart. You have to be very vigilant and agile if you are using a shorter frame time chart. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So now let's talk about the liquidity also. So where does the market move? Market moves where there is a liquidity, and liquidity is generally available beyond these resistance zones and around this support zone. So why liquidity is available? Because when market reaches these support zones, then lots of buyers will come here to buy, and there will be anyways panic in the market. So there will be lots of people who would be interested to sell here. So liquidity will come here. Similarly, for resistance zones, there will be many people who will think that they have achieved their target at these resistance, they will sell, and there will be many people who will buy because they will anticipate that this breakout will happen, market will move up. So there is lots of aggressive activity at these crucial points, which we call it support and we call it as resistance. So now for this particular piece, you need to go into the different charts, and this is the action for you. You try to identify where has the real breakout happened and where were the breakout happened but it was a false breakout. So once you see it in as many charts as possible, it will give you a lot of good idea about the market. Then you will identify real breakouts and the traps, and this exercise will build your ability to avoid bad trades, which is a major edge. And there is one very important aspect regarding the volume and the traps. So let's read out this volume chart, right? Let's see what is happening here. So market is looking at a wrong trade here. That means it's a trap. You see there is not much of volume here, right? Volume is just like average volume which has been going on. But at this point of time, when it has actually moved up, there is a big volume push. So this also gives a confirmation that this is a good volume breakout. That means this is a genuine breakout, not a trap. But this was a trap. Let's see again one more trap. Okay, so let's consider this point. Let's see, market was here, so it took resistance here, and this is our line which is coming as resistance. Now see here, everything looks good for a breakout, but see the volume. Volume is so less here, and here the breakout happened and you see the volume. So volume confirmation is a very important aspect to identify true and genuine breakout. So in the next session, we will combine everything: candles, patterns, traps and structures, and we will define a complete decision making framework for you. Welcome back. Here we are going to talk about a complete trading system for you, so that will help you out to take trades with confidence. So if we talk about standalone value tag from this particular session, then you have to understand a trading strategy is not just about finding entries, it's about managing risk. You will understand how to manage that risk, you will understand how to manage the capital, and then behavior across the entire trade until you exit the trade. So entries are in itself just half of the job. Next half is when to exit. So that creates your execution edge. You have executed the complete trade, entry and exit, then only you are going to take benefit out of it. So now let's start with some generic context. So what happens with most of the traders? Generally they don't struggle with the direction. They may struggle with the direction, but even if they get the direction right, they struggle with the execution. So just to bring this point home, we have seen that we are in the previous videos, we have shown that when we are in a uptrend, then a person is not able to take trade here, then he is not able to take trade here, then he is not able to take trade here. And I have discussed already, and I have already discussed the psychology why he was not able to take trade here, but he was willing to take a trade here, and then market was going to move down from here. So he was taking a trade from this point because of FOMO, fear of missing out. Okay, so we have discussed all of that. You can revisit those videos. So that's where we are saying people generally don't struggle with direction, but even if they get the direction correct, they will struggle with the execution. They will see the right move but don't enter in quick time, and then they lose the trade. So that is the inconsistency we have been talking about, and we want that to be eliminated from your trading decisions. So now let's move to the next part. Here in this session we are going to talk about a complete trading strategy which will be having four major components. So first component, where to enter. Second component, what is the stop loss. Third component, very important one, is the position sizing, how you are going to position your fund into different trades. And then what is the trade management, how you are going to scale your trade. So now let's talk about institutional cycle. And what is that institutional cycle? First, we need to see that entry into the trade is not random. It should not be random. No institution enters randomly in a trade. So it follows a repeatable sequence. They will find liquidity. We have discussed how to find liquidity because liquidity is available at support and resistance levels. So liquidity you can identify. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Then you have to avoid the trap which we discussed in previous video, how to avoid the trap. And then there is a expansion in the trade. Expansion in the sense, once you have taken the trade and after that it runs up or it runs down. So that is the expansion of the trade. So markets first move towards liquidity. We have already seen that. So here the liquidity will be highest. Again, here the liquidity will be highest. So market once goes down from this point, it is not going to stay here. It is going to go down towards the highest liquidity. Similarly, it will keep on happening, and that becomes your zone where there is lots of liquidity and lots of consolidation. So again, here you can see market has fallen to this level. Here the liquidity we are getting. Then going forward, we are getting lots of liquidity here, lots of liquidity here. That makes it a consolidation zone. And after that, expansion is happening. So now, first step, you have identified your entry criteria, that there is a liquidity in the region. Then second is trap. Once your liquidity is identified, you need to understand that you are not getting into the trap. You need to see if it is a genuine breakout or it's a false breakout, and accordingly you need to take the trade. And all of that we have explained in previous video like this one. So in this trade, when it is going down, we will wait. We will not get into the trade even here. We will wait for a day. If markets are going up, so we will enter at this point. That's not an issue. But we will not enter at this point because there is a large possibility that it could be a failure. So 1 or 2% we will leave for the market, and then we will enter at this zone and we will let the market run away. Third part of that is expansion. So after the trap, price moves aggressively. So exactly that's what we have just discussed. But for the sake of it, I am again saying it is expansion, which we have already covered now. So now, till now, what we have seen for the entry, we have seen three conditions. One is the liquidity, second is avoiding the trap, and third is the expansion. Now, second phase is regarding the stop loss. What is stop loss? How you are going to use that stop loss? So now, what do you do while you are picking up a stop loss? There is a very simple concept. There are two concepts, in fact, which you can apply. Suppose you are having investment of suppose X. So let's talk about $100. You are having an investment of $100 and you have invested $100 at this point of time. Now, looking at the chart, you may think that, okay, I will take a stop loss at 3%. So you are willing to take a risk of 3%. So stop loss could be based on your risk appetite. If you have risk appetite of 3%, you just enter into the trade at the appropriate levels, at the appropriate entry points, which we have explained already, and just put your stop loss 3% below that. Or what we can do, we can use charts and we can have the stop loss based on those charts. So now let's explain here. Suppose when you saw the breakout here, suppose you thought that this is a correct breakout. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So now we have discussed about the stop loss. Either you can place the stop loss based on your risk appetite, which I explained as like 3%, 4%, 5%, whatever the risk appetite is, or we can look at the chart. So suppose for this, you considered that this could be your real breakout, right? Now the risk is opportunities, it can go up, risk is it can go down. So what will be your appropriate stop loss? Your appropriate stop loss should be on this line, because if market goes below this line, then most likely it will go further down. But there is one simple concept for stop loss always. So suppose you are having a very rigid kind of stop loss and this is the level you want. Always put like half to 1% based on the kind of security. So half to 1% below that stop loss. So if you are talking about a level here, then if level is that, then you consider your level half to 1% above this level. So how do you consider whether you need to choose half percent or 1% above these levels or below these levels is based on the security. If security does not move much generally, so very stable kind of stocks, they don't show very big movement, then at these resistance or stop lines, you can put your stop loss or targets just 0.5% above or 0.5% below them. And if it is a security which is very volatile like silver, or if there is a Bitcoin kind of security which is very volatile, then you can put your stop loss and the targets maybe 2% on either side of these levels. So you can choose that wisely. And generally the rule is that of your total capital which you are investing, 2% kind of stop loss is normal. So you can choose 2% as a standard, just not to get confused with different securities, different time frames. You may be fixing it at 2% for yourself. And if you get mastery on the charts, then you can set it up based on the chart. So now we have covered two things. One is entry criteria we have covered, and now we have covered stop loss as well. Now third is the position sizing. Now when we talk about position sizing, what does that mean? That means suppose you are having 5. So what is position sizing? So what is position sizing? There are two aspects of position sizing. Suppose you are having $1,000, right? Let's take this example. Now you are not going to put all those thousands into a single trade for the single security. You may put 200 in one, 200 in another. So you may distribute that 1,000 into 5 to 10 stocks, so that if market goes down or particular stock goes down, then you are not going to wipe out complete portfolio of yours. So there will be a good amount of security, because if one stock falls, suppose 50% next morning, but others will be holding your portfolio. So that is one thing. Your position sizing should be based on how much capital you want to invest, and then distribute that capital into different securities. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Second part of the position sizing is that for that, suppose now for a particular stock you have invested 100. Now that 100 also you should be talking about maybe 2%, 3% or 4% maximum loss, which you should suffer. And after that, you will exit the stock. So suppose you have fixed a stop loss of 2%, but you are keeping it flexible because sometimes what happens because of some bad news, there is a temporary blip, temporary downturn in the stock, and then it might be moving up. So if you want to keep that flexibility, then you will have to maybe 2% more you can have for flexibility. So 2 plus 2, it will become 4. But 4% has to be your dead drop kind of a stop loss where you have to exit the market and book your losses no matter what happens next, so that you have the capital saved for your next trade. So that's how position sizing is maintained. And now, very important aspect, which is scaling. Now, what is scaling? Scaling simply means, now suppose you want to invest your $10,000 at this point of time, but when you have identified this opportunity, don't invest all 10,000, take it and invest maybe 3,000 here. Then you just see what is market doing. If you are convinced that market will definitely go up, then invest 30% here, 30% here, and maybe 30% here. Suppose market goes down and still you are convinced that in few days market will go up. So first 30% you will invest here, then next 30% here. So what's happening here, if market goes up and it keeps on going up, so there is no harm to you. You will not have a hard one, because you have invested here, it went into the profit. You have invested here, it went again in the profit. So averaging out is becoming at the higher level, but still market is moving up, so you are happy. But suppose you have invested here, market crashes here 5-10%, then you will say that next 30% you can invest here. So your average price will come here. So you will anyways not be having a hard one. You now think anyways market will go up in some days, so your average has come down. Similarly, next 30% you can invest based on when the next move comes in the market. So that means you're not going to put all the money at a go. You wait in segregated ways, and that's how you scale up your investment in any of the trades. So now the action for you: take your last 5 trades, break them into the entry timing, stop loss, scaling, and the position sizing, trade management kind of things, and then see what you have done and what you should have done. And similarly, you can look for other opportunities in the charts and try to mark that at this point of time you are going to you can mark in the chart that at a particular point of time you are going to take entry. If it moves up, you are going to scale it up. If it moves further up, you are going to scale it up, and at what point of time you are going to withdraw from the market or exit from the market. So do these exercises for yourself and you will be learning a lot of things about market. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Now, the last aspect. What is the percentage which you need to be a successful trader? When I say percentage, that means I am talking about success percentage. So, you have taken 100 trades. Out of that, even if you are successful in 50% of the trades, you are going to make serious money. Because, let me explain you why. You look any of the trade at the breakout. You take any of the trades at breakout. Generally, if breakout works well, then see here how much percentages you are getting. You are getting 10%, 15%, 20%, good amount of move, maybe even 5% move. So when it moves up, you get a good run of money. But just in case you are not able to have the stock which moves up, you have done the wrong entry. Your stop loss, it will be like 2%, 3% or 1% based on your risk appetite, which we have already explained. So generally a 2% loss versus a 10 to 50% of gain. You understand what I am saying? When market is moving up, it could gain 10%, 20%, 50%, anything it can gain. So 2% of loss against possibly 10, 15, 20% of gains. So even if you are 50%, even if you are having a 50% success rate, definitely you are going to be a profitable trader. If you can make it to 60 and 70, then there is nothing like that. And then you will be really a good trader or good investor who will always make money in the markets. So now just to recap, we have covered liquidity, traps, expansions. We have covered entry timings, exit timings, and then stop losses. We have covered what kind of position sizing you should be looking looking for, what kind of stop losses will be there, and based on that, how much percentage you need to be a successful trader. So what should be your success rate? Even a 40-50% success rate can make you a profitable trader, and it can generate income far beyond your fixed income return. So that's it for this session. Thank you.